Like many great athletes, they tend to deliver and perform when their backs are against the wall. The question for Nike is, will it do the same? As they reported their Q3 results later last week, shares slipped about 8% on the news. Over the past 1 year, shares are down close to 28%. So as we go through these Q3 results, we'll talk about why shares of Nike are falling. We'll talk about whether the turnaround is at least taking place over at Nike and what the future really looks like for this company. We'll take a look at some anecdotal evidence as it relates to their different geographic regions like North America and the all-important China, see how sales are performing in those regions, talk about maybe some comments Elliott Hill said on the conference call as it relates to their new innovation pipeline. And then we'll jump into the technicals. Shares aren't looking pretty as they're basically sliding in a pattern of lower highs and lower lows. We'll try to make some sense of Nike's short-term and long-term pattern. We'll talk more about that. Hey guys, hope you're doing well out there. It's been a while since we've checked in with shares of Nike, as again, year to date, you've not seen great performance with shares down about 11%. Keep in mind, you do get a dividend with this one now at roughly 2.3%. This company is known for returning capital to shareholders, also in the form of a buyback, which this company is executing on. Now, Q3 results, to put it lightly, weren't great. In fact, they were pretty atrocious as revenues declined about 9%, with revenues coming in at $11.3 billion. That did beat already lowered expectations by about $250 million. What you did see a beat on was the GAAP EPS that came in at 54 cents. But again, all things considered, these revenue results were pretty dismal over at Nike, as Nike Direct was down about 12% and roughly 10% on a constant currency basis, down to $4.7 billion. You had further struggling of the Nike brand digital sales, which were down about 15%, and the Nike-owned stores down about 2%. The all-important wholesale revenues did actually hold up a little bit better, down just, and I say just, 7% at $6.2 billion. This was really the issue when their previous CEO, John Donahoe, was at the helm. They were kicking those wholesale those wholesale partners to the curb. And then they eventually realized that those wholesale partners is what made Nike reach the end consumer. A lot of people reach Nike through their wholesale partners rather than going through Nike Direct themselves. Converse continues to be a relatively weak spot as those sales came in down 18%. And really all of those things take a hit on your gross margin as those declined roughly 3.3 percentage points. We'll take a look at the balance sheet as it relates to inventory, cash, and all those things. But before that, let's take a look at the guidance and the outlook this company tends to provide on the conference call. So management did forecast for Q4 revenues, which is the current quarter we're in, to decline in the mid-teens, with gross margins expected to decrease by another 4 to 5 percentage points. Guys, that is a lot, especially considering the fact that your gross margin already declined about 3.5 percentage points in this most recent quarter. And so with those expectations of mid-teens declining on your sales, that's what Wall Street has now updated to be. And so your revenue estimate in the midpoint is coming at about $10.7 billion. Again, that would be down roughly 15% year over year in the Q4. What you do have to look forward to over at Nike, though, is as you get into fiscal 2026, that really is the back half of fiscal 2026, sales are expected to once again pick up in acceleration, and you're supposed to see modest mid-single digit growth on your sales side, at least as you head into fiscal 2026. Now, will that happen? That's still yet to be seen. Now, on the Q&A, basically a few questions were asked to management as it relates to the timeline of cleaning up the classic shoe inventories, because really that's what they talked about, and that's really what they said caused a big decline in sales. That's what they're trying to do, is clean up those excess inventories, clean out some of those classic shoe lines that Nike was building up over the past couple of years. And Elliott Hill, the CEO, did explain that the efforts to right-size the inventory mix, both within direct along with their wholesale channels, is expected to see significant progress, again, by fiscal 2026. Then you also had some questions about the innovation pipeline, as that's something that management has extensively talked about over the past, as Nike needs to get back to a point of innovation and newness once again. And Elliott Hill did express confidence in the upcoming products, particularly in the running and basketball categories. And look, I've said this before, Nike at its core is a running shoe company. They make shoes and they're in the running category. That's the category that they really have to dominate. And when they let the ropes go in that category, like they have over the past couple of years, that's when they'll struggle. That's when other upstart brands like Hoka and On will come in and take market share from them. If Nike can dominate once again in the running shoe category, I think that will bring them back to what they used to be, at least in the past. And they've seen positive responses to their recent launches. That's the Pegasus Premium and the Vomero 18 launches as well. And then they were also asked about the timeline for new performance products. So think basketball, think tennis, along with soccer and all those things. and how growth in that segment will offset declines in the classic footwear segments. And well, they did say that they expect inflection points in fiscal 2026 as the new innovations gain scale. So they're continuing to say what they've said in the past, that the innovations will hit in 2026. By that time, CEO Elliott Hill would be at Nike for about a 1 year running the company as CEO, and we'll see whether or not those innovations can really impact the consumer into once again bringing them back to Nike's brand, at least compared to their competitors. Now, in terms of the most recent quarter, again, like we said at the top, things don't look pretty at all. In North America, things actually were relatively okay, with sales down just 4%, down to $4.8 billion. You did see footwear decline slightly faster at 9% down, but when you compare it on a 9-month basis, it was actually slightly better, as over the 9 months, you're down about 13% on your footwear in North America. Over in Europe, Middle East, and Africa, about similar story. As you saw footwear sales decline 11% over the last 9 months, you've seen a similar story. Over in the important region of China, this is really where I think Nike will have a super difficult time bringing the consumer back to their brand, simply because of the competition over in China. You've seen it from other brands, not just Nike, but brands like Starbucks, of course, brands like Tesla as well. The consumer over in China has not only tended to turn towards more domestic products, they're also specifically moving away from US products because of, again, the geopolitical tensions along with tariff issues as well. So keep that in mind. The important region of Greater China, I think, for Nike will continue to be weak over the next at least 2 to 3 quarters. Once they can see gains once again realized in China, I think that's when you see the brand begin to turn around. And so you saw your footwear sales in China down about 17%, even if you adjust for constant currency. Sales were down about 15%. That was particularly weak in this quarter, as over the last 9 months, you've been down about 11% on your footwear sales in Greater China. And then your total revenues in China declined at 17% in the most recent quarter as well. So China continues to be a weak spot, again, not just for Nike, but you look at other American brands that operate out of China, and you'll see similar evidence there as well. In the region of APAC, you're seeing footwear sales decline about 12%. Again, slightly faster than what we've seen over the last 9 months, where you saw footwear sales down about 8% in the APAC region. And then, like we said at the top, the Converse brand continues to struggle, as you're seeing revenues, which are relatively small. They're at just about 400 million, down roughly 18% on a year-over-year basis. So all things considered, you have the apparel and the equipment side of the business continuing to hold up the business just slightly, but at its core, Nike is a footwear company, and even more core to that, they are a running company. So until they gain dominance in the footwear and running categories, Nike continues to struggle, in my opinion. And I think that continues to happen for the next 2 to 3 quarters. It's like management said, in fiscal 2023, as you head into Q3 and beyond, you should see signs of those sales turn around. The first evidence of that should be out of the region of Greater China. Now, moving on to the P&L, things again look pretty bleak, as you saw your revenues down roughly 9%, came in at $11.3 billion. What's even worse is this company isn't able to control those cost of sales nearly as fast as their revenues fall. And so your cost of sales declining just 4%, that will pretty much blow up your gross profit, as that came down 16%, down to $4.6 billion, also taking a roughly 3.3% point hit on those gross margins. Again, for the full year, your gross margins are coming down to 43.5%. Now, despite all of this, the reason to be bullish on shares of Nike is the fact that they're continuing to invest in demand creation expense. This is one of the only companies, in fact, out there that is able to continue to invest in their athletes, invest in their brand, invest in sports marketing, when other brands maybe simply won't be able to. And so you see that demand creation expense up roughly 8%, up to $1.1 billion. And this is something that no other brand or no other company can really replicate, at least in the apparel industry. You take a look at companies like Hoka and On, they simply don't have the capital to invest in demand creation expense like a Nike does. It's very similar to how TSM invests in fabs when no other company can, or when Netflix invests in content when no other company can. This is what differentiates Nike from their competitors. And if they want to move forward and once again gain that brand ubiquity, they have to continue to invest in their demand creation expense. You see that for the full year as well, up 8%. And that's something I'd like to see this company continue to push the pedal as it relates to advertising and demand creation. On top of that, you did have overhead expense down roughly 13%. So they're trying to cut costs in other parts of the business, on the sales side, maybe a little bit on the G&A side, as those expenses came down to 2.8%. But all in all, you had your operating expenses increase, your gross margins decrease, and well, that should tell you what EBITDA will look like, as that was down roughly 40%. and your net income down roughly 30% as this company is executing on a buyback. So your EPS down not nearly as much as your EBITDA. But again, all things considered, I think Nike still probably has another couple of quarters of similar results, especially when they're guiding for those sales to be down in the mid-teens heading into Q4. Now, speaking of their balance sheet, things still look relatively okay. This company is well capitalized. You're sitting on roughly $8.6 billion of cash and equivalents. And when you come down to the liabilities, not a whole lot, roughly 7.9 in long-term debt. You did get about $1 billion of that moved over to the short-term debt side. So all in all, your balance sheet still looking relatively okay. This company is able to continue to invest, at least in those demand creation expenses. That continues to be what differentiates this company, at least from competitors. Now, moving on to the technicals, one of the main reasons to avoid Nike stock at the current point would simply be the technicals. We've talked about it on the channel many times here before. You tend to not step in and buy shares of a stock that's in such a steep decline, such a steep downtrend, as you're making a pattern of lower lows and lower highs. And so purely from a technical perspective, you'd likely want to wait for this one to rebound, confirm a set of new higher highs, and that should tell you you'll break out of this downtrending channel. If you stretch it out over a longer period of time, I mean, this is going back all the way to the 1990s, and Nike has been in a steady uptrend. If you are a long-term bull, which you'd like to see is shares of Nike once again pop back into this uptrend. I mean, that would be a close to 20 to 30% move, but that should confirm that this downtrend is firmly over. Until then, I did highlight this green box. This is a buying zone where I would consider Nike shares to be pretty attractive. And if you do snap on a fixed range volume profile, you see where buyers tend to step in. The vast majority of volume sitting somewhere between the mid 50s up to the low $70 range. And so that green box should provide some level of support where shares of Nike can see some demand. And so if you are a long-term investor and you do have a long-term horizon as it relates to Nike, this would be a pretty attractive region to accumulate shares of Nike, especially considering the fact that you get a dividend, you're also getting a buyback, and you firmly have to believe that the new CEO, Elliott Hill, will certainly turn around this business in the form of innovation, in the form of demand creation, along with getting back into their wholesale channels, as he has a pretty good relation with their existing wholesale partners. And so from that perspective, this is a region somewhere in the low to mid 60s where accumulating shares of Nike would make sense from a long-term buy and hold perspective. But in the short term, you could have further downside considering the fact that the technicals are looking pretty bleak. You also have forecasts for the next couple of quarters to see declining sales. But if Nike is that turnaround story in late fiscal 2026, accumulating shares in the mid 60s certainly makes a lot of sense at the current time. Let me know your thoughts on this one in the comment section below. Certainly a company that is going through some tough times, but that's why they placed the new management. It's also one of those brands that's continued to be resilient through multiple downturns in their history. The question remains, will it be able to do the same once again? Let me know your thoughts in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.